Welcome to the Techno Fundamental Report for January the 8th. You know, we can make things more difficult, or we can work it in the direction of making things less difficult. So what I'm talking about here is a strategy called trend following, and I'm going to get into it here in a minute, but I wanted to mention one thing up front is our big problem right now with the markets and the economy is inflation. And it's so deceptive. Because back in the 70s and the 80s was a very difficult period for investing. And the inflation was caused by things that don't even really relate today. So that's why it's so deceptive. I mean, inflation can be caused by many things, but primarily it's just printing too much money. So what happened here back in the 70s was that we had something called the Nifty 50. And it's very kind of similar to the Mag 7 that we're dealing with today. So you should be very careful about this. Because the Nifty 50 was a group of stocks that were incredibly popular. And I mean, basically, people, that's all they bought was these Nifty 50 stocks. And we're talking about things like Coca-Cola and General Electric. And those were in their heyday. I mean, they were in their good years there. A couple companies went bankrupt. Xerox, Polaroid is an example. Today's blue chip stocks in several ways resemble Nifty 50 stocks of prior decades. Now, we've been saying that kind of stuff for years, so you got to take it with a grain of salt. But the point being is this was a devastating period, and I was in the market during this period. And it was just so difficult. You couldn't give a stock away. I mean, it was incredibly difficult. And interest rates kept going up. Inflation was a problem. Now, the real problem was that inflation would get under control. The Fed would bring interest rates down, which would cause the market to rally. But then inflation would come roaring back, and the Fed started having to contract again. So you can see the trend. The trend is down. Now, we had a head fake in here, but primary trend, and we're going to talk about the primary trend is down. So if you've been using a trend following strategy, you would have had a very defensive portfolio, primarily in cash, because there was just probably very few companies' stock prices doing well here. Now, the key to this whole thing is that you had to find the next Nifty 50. So the Nifty 50, the bubble pops, comes down, but then a little company called Walmart comes along, or McDonald's, or Home Depot. In other words, it wasn't the end of the world. It was just too many people were in the stocks, and it was a bubble, and it popped. That's basically what happened here. Now, there's a lot of correlations going on here between Ronald Reagan's administration and Donald Trump's administration. And the main point is they both appear to be, or are, very business friendly, which is great. I really like that. But sometimes good news is bad news. We just don't know yet. But what happened here back in the 80s was when Reagan came in. Now, he didn't come in 80. I think he came in 82. And you can see here the peak in the federal funds rate. This is the federal funds interest rate. So you can see where interest rates peaked here, and then we're coming down over an extended period of time because inflation came under control. So the point being is that interest rates are critical here. So if you go back and look at a graph of what happened to the market during that Reagan, after we had a big recession in here, that pretty much settled everything down, and then we started an uptrend. And it was a major bull market. It was just a fantastic bull market. But you had a head fake in here, which was the crash of 87. Ed Yardeni, he is basically estimating that the Dow will go to, the S&P 500 will go to 10,000 by the end of the decade. Pause your video player. You might want to read this. He talks about the Trump administration. That is, in other words, he's saying it's going to be very positive. So, but I'm not big on predictions. I think that's great, and I hope he's right. But I'm going to go with trend following. If the trend is up, I like it. If the trend is down, I don't like it. Steve Moore, he is one of Trump's economists. He's proposing something. I just wanted to talk about this because I just thought it was fascinating that this could happen. He is saying it is very possible that we could go to a flat tax of 15%, a federal flat tax of 15%. Would that be great? You would do your tax return on the back of a postcard. We spend more money on tax preparation than most people would believe. I don't know how much it is, but it's a lot. And of course, that's a difficult thing for the CPA industry, but we could go to a flat tax. He is saying that with the tax cuts, the Trump tax cuts that are to be renewed this year, you already have doubled the standard deduction. So it's almost like you don't itemize anymore. So he is saying we could easily go to just no itemization at all and a 15% flat tax. And you would also increase the base of taxpayers with this. So let's take a look at the market. NASDAQ starting to show some cracks here. We've got, we made our high mid-December, coming down. Power trend, however, is still intact because it's not unless the 21-day crosses below the 50 does that mean the end of the power trend. So if we look at a little bit under the hood here a little bit, and we look at the S&P 500, you can see that the power trend is very close to ending here. Now, it has already ended on the mid-caps. The power trend has also ended on the New York Stock Exchange stocks. That's a big group. It's also ended on the small caps, which the small caps are important because that's a risk-on, risk-off index. And when the risk is off, you're going to see it in the small caps. They're also very sensitive to higher interest rates. The equally weighted S&P, the power trend has turned off. And unfortunately, it was really a nice rally and everything was looking great, but the culprit is interest rates. And realize this indicator, which is the power index, not the power trend, but the power index, this is designed to tell you what the Federal Reserve plans to do. Now, I've been using this particular indicator for a long time, and it's right more than it's wrong. So right now we're above zero. We've gotten to over 7.5 on the indicator. You can see easily here that the trend in interest rates on the 5-year Treasury, they're up. Here's our trend meter as well, and you can see it's in the green. Interest rates on the 5-year Treasury over the last 125 trading days have climbed 8.34%. Now, that's not chump change. That's a big amount of move. And so what it's basically telling you is inflation could be starting to raise its head again, and the Fed's worried about it. In fact, they came out today and said they were worried about it. However, the good news is this, and there is good news. The primary trend continues to be up. The S&P, the primary trend is up. The NASDAQ primary trend is up. So we take it a day at a time. However, I would be defensive in here. I would wait to see what goes on with interest rates. If interest rates continue to climb, it's going to be a problem. Call me if you have any questions. Thank you very much.